Hello, everyone. Welcome to our peer-to-peer sessions, The Importance of Keeping Proper Books with MJ Tax and Business Service. My name is Hendrik Hernandez Resto. I am the creative specialist at New Bedford Creative. Thank you for joining us today. Before I go any further, please enter your first and last name into the chat along with your email for our records. Thank you. This peer-to-peer series is geared to enrich, educate, and connect creatives within our community. New Bedford is the home of artists, creatives, changemakers, designers, entrepreneurs, and community enthusiasts. The peer-to-peer sessions embraces the pulse that makes New Bedford so unique while also expanding our knowledge and connections. New Bedford Creative offers many opportunities for artists and cultural organizations. Join our creative directory, apply for one of our grants, or call to arts. List your event on our calendar, all for free at our website, newbedfordcreative.org. Peer-to-peer sessions is supported in part by the City of New Bedford through its American Rescue Plan Award and Arts, Culture, and Tourism Fund, facilitated by New Bedford Creative at the New Bedford Economic Development Council. We would like to thank Mayor John Mitchell, his administration, and the entire City of New Bedford, and the entire New Bedford City Council for their continued support of the creative sector. This is just one component of a broader initiative to boost arts-based economic development and help the creative sector recover from the pandemic. Before I introduce our presenters, I want to go over the format for this session. Once I'm done, I will pass it over to Jessica Prince and Arianna Swink of MJ Tax and Business Services. Once Jessica and Arianna are finished, we will open up for Q&A. I will review the questions in the chat first, and then we will continue with the Q&A live. We will have about 20 minutes for questions so we can wrap up on time by 2 p.m. Just so everyone is aware, the session will be recorded. Please feel free to put your questions in the chat so we don't miss them when we open up for Q&A. Most sessions throughout this series have been recorded and can be found on our YouTube channel at New Bedford Creative in the following week. Now, I would like to introduce our guest speakers, Jessica Prince and Arianna Swink of MJ Tax and Business Services, who will teach us what they know about the importance of keeping proper books. I will now pass it over to Jessica and Arianna to share more details of who they are and what they will present for us today. Go for it, ladies. I am muting myself now.
Thank you, Hendrik. So I'm going to be presenting today, and Arianna is going to be manning the slides. So thank you for joining this class. I wanted to say that this is going to be a broad overview of kind of general record keeping and how that ties into keeping proper books, because I feel like there are a lot of components that comprise a proper set of books. So why would you want to keep proper books? Really, this is going to save you time and money. So I'm sure all of us have been in a situation where it's the end of the year or you're up against a deadline and now you're trying to play catch up. And it's a lot harder to catch up an entire year's worth of bookkeeping in one session than it is if you just maintain it. So I don't know if you remember what you did a year ago, if you're looking at a receipt and trying to figure out what you purchased and was that business related. I can't remember. If you keep your books up to date, this isn't going to trouble you at the end of the year every year. And I assure you, it will save you time if you just maintain it while your memory is fresh. Will it save you money? Yes, because if you are keeping all of your receipts and you're keeping your books up to date, you're not missing expenses. But more importantly, you are not overpaying your taxes because you missed expenses. So it isn't one type of tax that you could potentially be overpaying. You could overpay on income tax, you can overpay on your self-employment tax, but also your sales tax. So one thing that a lot of artists or clients who sell items in general tend to have a hard time learning initially is how to keep records for fiduciary taxes. Fiduciary taxes are taxes that you are holding on behalf of somebody else. So if you are selling a work of art and it is subject to sales tax, that sales tax does not belong to you. And you are required to relinquish that to the proper tax authority. Here it's the state of Massachusetts, Department of Revenue. So I'll touch on that a little later. I wanted to open this session with a little bit of a scare tactic and talk about interest and penalties. So there are a number of penalties that you could be subject to if you don't file your taxes on time or if you don't pay on time. So there is an easy way to avoid additional interest and penalties as a self-employed individual or a business owner. Pay quarterly estimated tax payments. So at the end of the year, the IRS wants to see that you have paid in 90% of the current year's tax liability or 100% of what was shown on the previous year's tax return. How do you calculate that? Well, you need to have your books pretty up to date to know what those figures are going to be. At the end of the year, the IRS does not want you to owe more than $1,000. If you do, you could be subject to penalties for not withholding proper taxes. And if you're self-employed and you don't have taxes withheld from any income source, that means you are required to pay in quarterly. The current interest rate with the IRS is 8%. So you don't want to be subject to any of those penalties. Failure to file penalty is typically 5% of any unpaid taxes once you do file the tax return with a maximum of 25%. So make sure you file your tax return. That's the easiest way to avoid interest and penalties. File your return, even if you can't pay, because there is an additional penalty for not filing. So now we're going to talk about, just briefly go over what we're going to talk about today. So our agenda is basically record keeping. What do you need to keep track of? We're going to recap what self-employment tax is and then talk a little bit more about estimates. What do tax forms look like that you may receive as a self-employed individual? Are you an employee or are you an independent contractor? And how does the state of Massachusetts look at each of those? Should you keep an inventory? Are you required to keep an inventory? Vehicle use. Do you want to be reimbursed for your mileage? And then an example of books, because the books that you keep are going to get more complicated as you change entity types. So next slide. So record keeping. What do you have to keep and for how long? So you obviously want to keep a couple copies of your tax return, and we'll talk about how many years in a minute. Minimum of 3. The tax forms that were used to prepare your return, because if you do need to substantiate anything on your tax return and you don't have the W-2s or the 1099s and you get a letter requesting proof of these items a year from now and you don't have them, you have to pull transcripts. It's cumbersome. It would be more advantageous to just keep all of your tax forms with your tax return, file it away somewhere. So that would be your proof of income and expenses. If you're self-employed, that might be bank statements. You need the receipts that accompany those bank statements or credit card statements. If you are paying cash for items, keep those receipts. I would say that if you own a business, whether you're a sole proprietor or you're a corporation, if you spend money on one postage stamp, that's a deduction and you want to have proof of it. Really down to the tiniest item, these things add up. If you're spending a couple dollars a day, $15, $20 a week here and there, at the end of the year, that's a decent amount of money. So keep all of the receipts. And part of the reason that's important is because if by chance you are ever audited, just having a bank statement doesn't prove what you've purchased. So I can go to Michael's and purchase art supplies, but I could also go there and buy a lot of candy. So you don't know what is being purchased unless you have that actual receipt. So please keep receipts. And if you are audited, you do have to provide that substantiation. So keep it. Do you have to keep paper? Not necessarily. I have had people come in with totes of unopened mail and receipts. Do I keep all of that paper? And do they keep all of that paper? Absolutely not. We scan all of it. And electronic file cabinets are great. But if you lose your computer and you lose all of those electronic records, that's as bad as losing all of the paper. So I would say even apps where you can take a picture of your receipt are great. Make sure they're being backed up somewhere, because if they aren't, you have the potential to lose your records. Next. So how long should you keep a tax return? So the minimum number of years is 3 years. And this is important because if you timely file a tax return and you're keeping all of the records that are associated with that tax return, the statute will expire in 3 years. What does that mean? It means that your tax return is actually a live open tax return for 3 years from the date that it is due. So right now, if we're counting backwards, we all just filed a 2023 tax return. That means 22 and 21 are also still live active tax returns. You need to have those. At this point, 20 has expired or will expire upon the due date of next year's return. So you're not going to get a tax refund from 2020 at this point. If you were due a refund and you file that return, it will likely be rejected, should be rejected. Another reason to file your tax return, if you are due a refund, you could lose it. If you owe money, don't worry, the IRS wants all of those tax returns. They have records going back anywhere between 7 and 10 years. If you never file that tax return, they can go back as long as they have a record and request that you file that tax return. Also, if by chance you are committing tax fraud, they could go back as far as they want. If you omit more than 25% of your income, that statute is now 6 years. So you could do this accidentally. You could be ballparking your expenses because you haven't kept proper records. Perhaps you don't reconcile your bank account, and 1 year you doubled all of your expenses. And by chance, you have exceeded that 25% and the IRS somehow catches this, they can then go back 6 years. So, do you need to keep your tax return for 6 years? Potentially, if you aren't keeping proper books. So it depends. There are also some different statutes regarding amended returns, and we're not going to delve into that, but keep your tax return for at least 3 years. All right, next. So this is kind of a touchy subject lately. Massachusetts was actually on board with issuing 1099-Ks before the entire country. But this has been a subject of concern for some states because there are a lot of people who are going to start receiving 1099-Ks. This could actually be a mix of personal and business. So keeping proper books is going to help differentiate between whether or not you're actually receiving a 1099-K for business reasons. What is a 1099-K? It's issued by electronic payment processors. So that could be a credit card. It could be an auction site, a peer-to-peer payment site. So PayPal issues these. Do you accept PayPal? Venmo does not want to participate in this, but any credit card processor. So Square, how many small retailers use Square? They're going to issue a 1099-K for any credit cards that are processed. And they actually also have the option of running all of your payments through that app. So even some of your cash sales might be captured, at least for sales tax purposes. But the 1099-K is going to be issued. It's broken down by month. It tells you the number of transactions, and it tells you how much you received. It does not necessarily show refunds, however. So the total amount that shows up on your 1099-K is not necessarily indicative of your income. So taking that number directly off the 1099-K could be inaccurate, and hence you need proper bookkeeping. So you keep track of what you actually received as income. Okay, next slide. So I threw out that 1099-K before self-employment tax only because every business has the potential to receive a 1099-K. You could receive it in your social security number. You could receive it in the EIN of a business. But self-employment tax is something that only sole proprietors and partners in partnerships are subject to. So this is actually a pretty hefty tax, and it's on top of your income tax. It's a separate tax that's comprised of your Social Security and Medicare tax. So typically, as an employee, your employer would pay half of this for you. But when you're self-employed, you're going to pay the employee and the employer portion. So this 15.3% is actually 12.4% Social Security and 2.9% Medicare tax. And this is not a flat tax forever. For those of us that are fortunate enough in 2024 to make more than $168,600 of net self-employment earnings, it will stop at that point, and you will not pay any more Social Security tax. So just that 12.4% portion. However, Medicare keeps going. And not only does it keep going, if you make in excess of $200,000 as an individual or $250,000 if you're married, an additional 0.9% Medicare tax could be assessed. So for the majority of us, 15.3 works. Once your income starts getting up there a little bit, then it depends. All right, next. So, how do we know if we're going to pay self-employment tax? Well, if you're an independent contractor, that's a sole proprietor, or you're a partner in a partnership. But how do you know if you're an employee or not? So an employee is going to receive a W-2, an indication that you are going to be an employee rather than an independent contractor is, were you handed a W-4 to fill out when you started a position? If you're working for somebody else, they need to know how much tax to withhold from your paycheck. And that's what a W-4 is going to determine. In Massachusetts, the Department of Revenue feels that very, very few people are actually independent contractors unless you own your own business. So unless you've set up an EIN number, you have a name, you have a profit motive, you're probably an employee and should be paid as an employee. If you are being told when to show up, what to do, the materials are being provided for you. Let's say, for instance, as artists, you're going to work in a pottery studio. And I say, I would like you to work Monday through Friday from 9 to 5. Just show up, I'm going to give you a half-hour unpaid lunch, and I'm providing everything that you need. You just come to work. I have aprons, I have all the tools. That person would be an employee. Unless by chance they owned their own business and they're doing this as part of their business. Perhaps they were contracted for 1 week to come in as a guest and teach classes in the studio for a week. If they have their own business, they can be an independent contractor. If this is somebody off the street coming in to do the exact same position, chances are they're an employee. And that means setting up payroll, filling out a W-4. If you are an independent contractor, you are going to fill out a W-9. And a W-9 is going to either have your social security number or an EIN number on it. Oop, I just lost my Zoom. Oh no. Okay, I'm
Well,
back.
I just wanted to make sure. Good.
Um, and I lost my train of thought. If you're an independent contractor, you're going to fill out a W-9. I would encourage everybody to get an EIN number, which is an employee identification number, so that when you're filling this out, so you can receive a 1099 from the person who is paying you, your social security number isn't being put out there everywhere. It's just there's rampant identity theft, and if you can avoid putting your social security number out there, please do it. Okay, next. So as an independent contractor, you're likely going to receive a potential of 2 forms. You should get these in the mail by January 31st, but not always. So a 1099 NEC is for non-employee compensation. So if you're not an employee, you could receive this form. This form made a recent comeback, and it had been in existence years ago. It was kind of discontinued, and we were using a 1099 miscellaneous, but specifically, non-employee compensation does belong on this form. So you'll see an area for the payee, the recipient. Where it says the recipient's TIN, you're going to want to use an EIN number. That's where you would fill in that EIN number. If for any reason any federal or state income tax is withheld, you're required to receive one of these forms. You might also issue one of these forms. If you pay anybody more than $600 in a calendar year, then you should be getting a W-9 from that person prior to paying them, because sometimes after you pay people, it's hard to get them to fill this form out. You want to deduct what you're paying to that person as an expense. So get a W-9, issue these forms. If you fail to issue one of these forms as an employer, so you can be an independent contractor and sub out some jobs and still need to issue one of these as an artist, especially if you have to pay commission. If you don't issue this form, the penalty, the fine penalty for not filing is $60 each for each of one of these that you fail to file, up to $664,000. So I don't think any of us have to worry about that max penalty. But if you're going to pay somebody and they are not incorporated, let me add that. If somebody is incorporated, you will know as they have INC after their legal name. You do not have to issue this form. If they have elected subchapter S status, you also do not need to issue this form. So get a W-9. That's going to tell you whether or not you have to issue one of these forms. Next. This is a 1099 miscellaneous. So as an artist, you might also either receive one of these or need to issue one. If you have a studio and you're renting out stalls or booth spaces, you might need to receive these because or issue them because there's rent involved. typically not royalties unless perhaps you're a musician. Musicians do receive royalties, and I'm just going to throw out there that artist is kind of a general category, but musicians certainly fall under that category. If they receive royalties, it actually belongs on a Schedule C, not a Schedule E, along with authors. I'm just throwing that out in case it pertains to anybody. But these are issued also to attorneys. There are different limitations. So if you're paying an attorney to help incorporate or to set up your business, you might need to issue a 1099 to the attorney, even if they're incorporated. So maybe you should consult a tax preparer or a CPA, enrolled agent, to make sure that you don't need to file any of these at the end of the year. So next. So I'm jumping around a little bit. One thing that is particular to artists is you tend to have a lot of supplies. And I just want to touch base on inventory and cost of goods sold, because the word inventory from a real life perspective and the actual definition of inventory is what do you have that you're using to produce a product out of. But when is it necessary to actually keep an inventory from a bookkeeping perspective? If you are not grossing more than $1 million, you are not required to use an accrual basis. So I'm getting a little technical here, but you can have two types of accounting method. Cash, which is the easiest, which most of you should be if you have a small business. I receive money on December 31st. That income is reported on December 31st because that's when I took constructive receipt of that income. I paid an expense the last day of the year. I get to record that in that year. Not always necessarily the case with accrual. You really have to record the income and the expenses in the time period that they pertain to. If you have sales in excess of $1 million and you are selling an actual product, you are manufacturing a product, then you need to use an accrual basis and you might have to track an actual inventory. But you do have the option of tracking inventory even if you are not required to by law. The benefit of that is that you're actually keeping track of your materials, and really everybody should keep track of their materials to know what they're putting into a product that's being produced. And that the items that are consumed will end up being your cost of goods sold. So at the beginning of the year, you might have $1,000 worth of art supplies. You might make additional purchases during that year, but you might not. So you really want to keep track of, am I using materials that I had in-house already? Maybe I didn't need to purchase anything that year, but that still has a value. What you are using cost you something, and you want to take that as a deduction. So we can do that in a couple of different ways. I love accounting software. However, a spreadsheet would suffice with a sole proprietorship. So once you start getting into electing entity status, so partnership, an S-Corp, a corporation, you really do need to have proper books. And we're going to take a look at what those financial statements are going to look like in a minute. But you're going to see that inventory and cost of goods sold are items on those financial statements. Next. I wanted to highlight a couple of relevant expenses that require extra bookkeeping or extra record keeping, because these are expenses that are going to show up in your financial statements, but you need to have additional substantiation for them because it's required by the IRS. So when you have a vehicle and you want to use it for business, you have a couple of options depending on your entity type. The easiest way to keep track of the cost of using your vehicle is to use a standard mileage rate. So this has changed quite a bit over the years. I pulled a historic value just to give you an idea. Back in 1994, we were being reimbursed at a rate of 29 cents a mile. Right now, we're at 67 cents a mile, but last year was only 65.5 cents a mile. So really keeping track of your mileage is important because now for every less than 2 miles you drive, you're going to get to reduce your taxable income by $1, right? So who wants to pay more tax if they're driving around for business? You can actually accumulate 67 cents a mile, keep track of it, and then reduce your income by that amount. So it does change all the time, as you can see in this chart. So one of the things you might want to do is download an app. There is a free app called Mile IQ. There are a few others. They'll actually print a report for you at the end of the year. And it's scary how smart your phone is because when you get in the car and you start driving, it will recognize where you just went. And if you do it enough times and you log it enough times, it will know where you're going. And if you're driving to Market Basket from your house, you're going to get groceries. You're not going to buy art supplies. So your phone will start to categorize these trips for you. But you also have the option of going in and changing the categories. But keep track of it because if you aren't, you're losing a potential expense. The thing is, if your home is where you're starting, and then you're going out, and even if you're going to the post office to send a package with a piece of artwork that you've created, if you are going to buy supplies and you've kept track of this, to be able to deduct your mileage, you need a starting point. And if that starting point is your house, you need to have an office and home. And I just want to throw out there that in addition to the standard mileage rate, you actually also have the option of taking actual expenses. It's more complicated. A standard mileage rate is kind of an umbrella that includes your gas, your insurance, any repairs, oil changes, tires, all car expenses with the exception of tolls and parking. Those are in addition to the standard mileage rate. Or you can take actual expenses. If you have a 100% business use vehicle or any vehicle that exceeds 50% business use, you have the potential to then take depreciation, take actual expenses. There's more record keeping involved in that. But regardless of actual or standard, if you're starting at your house and you're going somewhere for business, your office and home needs to consist of a place that you are using exclusively for business purposes. So office is kind of a misnomer because it could be a closet full of supplies. As long as you have a space dedicated to that business. It could be a corner of a room. It could be an entire room. It could be a studio. There are a couple different ways that you can deduct an office and home expense. There is a safe harbor. It's a flat $5 per square foot of area that you are using, up to 300 square feet. Anything beyond that, the IRS, I'm guessing, is saying it's too big to be in a home office. Or you can take actual expenses. So if you have an entire barn and you're using that for art classes, that entire barn is going to be deductible, but you need to use actual expenses. which means there's going to be depreciation involved. You're going to need to track any property-wide expenses like utilities, water bills if it's relevant, property taxes, property insurance. And then you're going to prorate those expenses based on the percentage of space that is used for business and the overall square footage of the usable space. A little more complicated than we need to talk about right now, but home office is a potential deduction. Just bear in mind that you need to keep track of it. Next. So if you are a sole proprietor, like I said, you could use an Excel spreadsheet. We need income, we need expenses. Unfortunately, sometimes we receive this handwritten on a piece of paper. That is acceptable as a sole proprietor. However, once you have elected an entity status, partnership, S-Corp, corporation, you need to keep proper books. And part of the reason is that the front portion of your tax return is essentially a profit and loss statement, which is what we're looking at right here. The other part that could potentially be on your tax return is a balance sheet, which we will look at in a second. That's the balance sheet. Yep, thanks. So let's just take a look at what this consists of quickly, because I do want to get questions from people, but you're basically going to take your income. Where did your income come from? This can be broken down into as many categories as you want. And I would like to just throw out there that if you use accounting software, get as detailed as you can without burdening yourself, only because the more year-over-year comparisons that you can create in different categories, it's going to identify where your profit is coming from and maybe identify some items that you should no longer sell or create. So you can see in this example that there was more interest income, but imagine that we're selling jam and we have this broken down by different types of jams. Well, everybody loves hot pepper jam, but not everybody wants jam made out of durian. So if you want to track some of those specialty items to see if they're actually selling, this is where you could potentially do that. Anyway. The next section are the expenses. So you could, I just want to throw out there, you can also see cost of goods sold in there that we mentioned earlier. So that's the cost of what you paid for any items to earn that income. So the expenses are in the section below that. There is a salary expense. I also want to throw out there that if you are an S-Corp or corporation, that might be broken up differently, but this is just an example. Also, depending on what type of entity you are, charitable contributions are going to end up somewhere else. But you're going to see that there is some amortization on this. We're going to talk about what that is in a second. But you can see how the income at the very bottom changes from year to year. And I like to pull comparison income financial statements just so I can see how things changed. Next. So this is a balance sheet, and a balance sheet needs to balance. And what are we trying to balance? Your assets in the top section need to equal your liabilities and your equity. What are assets? And why is it important that we keep track of them? Because it's going to determine whether or not your business has any funds to operate in some capacity, but also all of this needs to end up on a Schedule L on entity tax returns. So your cash is obviously an asset, but your inventory is an asset as well. So this ties back to your cost of goods sold, and your ending inventory should be your beginning inventory for the next year. Sorry. Any buildings that you have, any furniture and fixtures, any tangible assets with a useful life of more than 1 year have the potential to be depreciated. So you can see that there is some accumulated depreciation on this building and furniture and machinery. Land is never depreciated, so land is not part of that. In the bottom section, a mortgage is a liability. That's an amount owed to financial institution for the property. Capital stock, that's what the shareholder put down initially into the business. Additional paid-in capital is when you need to fund your business and you're just putting money into it. Retained earnings is the amount of money that you have already paid tax on or that you kept in the business and have not removed yet. So you'll notice that the top section and the bottom section are the same number. They need to balance. Next. So just to throw this out there, depreciation is when you take the price of an asset, something that has a useful life of more than 1 year, and it's categorized by what that asset is. And there is a difference between book depreciation and tax depreciation, unless you happen to use the tax depreciation on the books. You don't get to take the entire expense upfront in 1 year. If I'm going to buy a printing press, it's going to be really expensive, and I'd love to deduct that in year 1. But you can't under normal circumstances. You cannot. It's going to be assigned a useful life, and you get to take a sliver of that purchase price every year until it's used up. So this just has a couple of examples of and actually I would say that the tax depreciation is probably more relevant to you, because you can see that some items are going to be depreciated over a different period of time. Telephones, 7 years, not the 10 years you might have on the books if you're actually a large corporation. So the difference between depreciation and amortization is that depreciation is a tangible item. You can touch it. It's a copy machine, a cash register. Amortization is an intangible asset, meaning you can't touch it. Startup cost, organization cost, closing cost. Perhaps you needed to take out a small business loan and there were some closing costs associated with that. There is a special depreciation that you could take. It's a 179 deduction, which means that you have the potential to take some or all of the entire cost of a depreciable asset in year 1 if it meets certain criteria. There's also been something called bonus depreciation at the federal level the last few years. In 2023, that was at 80%. The year before that, it was 100%. It's supposed to slowly be declining, but with any new tax law changes, it could come right back to 100%. You really need to be careful in Massachusetts because Massachusetts does not conform, meaning they're not going to recognize it. So I would say seek the advice of a professional if you are beginning to purchase assets. Perhaps don't try that on your own, unless you're really familiar with what you need to do and what you need to track to report that properly. Next. So that was a really broad overview, and I could go off on tangents for hours if you have specific questions. But we are going to be teaching a class next week as well, and that's how to set up a business. And I'm going to go through the different types of businesses and what you would need to do to get started. Does anybody have any questions? I wanted to leave a little bit of time. do you guys want to throw out there what kind of business you have and what you currently use as a method of keeping track of your records? Do you use a spreadsheet? Do you keep an envelope system? Do you use accounting software like QuickBooks? I'm just curious. It's actually really easy to get an EIN. Margot was inquiring about how easy is it to get an EIN. It is so easy. And actually, if I can Google this really fast, I'll actually put it in the chat. There is a self-service option with the IRS, and as long as you answer all of the questions correctly, you can get yourself an EIN number in about 5 minutes. So do you need to pay somebody to get that for you? You really don't have to, as long as you answer the questions properly. So let me just see if I can throw that website in here for you. I just want to caution that you want to make sure you're on the correct website, because a lot of Google searches, if you Google get EIN number online, will want to charge you to do it.
I
That's
believe
where
I
you want to
found it.
go.
I believe I found, oh, you found it? Excellent.
Yep.
Good.
Yes, we will give you access to the slides. I think we need to send those to Hendrik, and maybe you can email. Okay.
Ariana and I will have texted about it. I will, as soon as I get them, I'll send them all out to everyone who registered and anyone who showed up today.
And if you ever have questions, you can always reach out to Ariana and myself. And we love to talk about taxes. So I have every version of QuickBooks known to man, only because I need to make sure that I can open all of my clients' files. I would say that the easiest thing to do is start with a spreadsheet. And if it gets to the point where you're a sole proprietor and it's just getting really messy and you can't keep up with the spreadsheet, start with a basic version of QuickBooks. I know that they're starting to phase out the desktop version. They're really pushing people towards QuickBooks Online. You can get some basic QuickBooks software for about $160 a year for really, really basic. I mean, income and expenses and not much more. I think Peachtree still exists. There are different accounting softwares. They really do all accomplish a similar goal. You end up with a profit and loss and hopefully a balance sheet if you need one. But I know I've been using QuickBooks for 20 years, since the beginning of my career, and I really love the utility. And once you start getting some more complicated businesses and entity types, then you can upgrade your software so QuickBooks can grow with you. I don't get any kind of kickback from QuickBooks. It's just the software I happen to prefer, so that's why I use that. But really, you just want to make sure you're reconciling your bank account. So keep everything separate, have a separate bank account, have a separate credit card, and you need to reconcile those statements because you might have missed an expense, you might have missed a deposit. Everything going in and out of that bank account or credit card, you really need to have it be used just for business. Keep your personal expenditures out of it entirely. Don't pay for something out of the business, then put money back into the business account. Just don't do it. If you need to spend money personally, transfer it to yourself first and then spend it. Anybody else?
If you do have questions, please just take yourself off of mute or you can slide them in the chat. We are actively monitoring that chat. But if you want to ask one out loud, use your voice, go right ahead. Going once, going twice, three times. Jess, Ariana, is there anything else you'd like to add?
Back next week. We'll tell you how to set up your your business.
Yes, next week, Jess and Ariana will be back, same time, same network. That'll be August 8th. I mean, I'm sorry, October 8th. Already in October. October 8th, 1 to 2 p.m. And you'll be talking about what was it again? Refresh my memory.
Setting up your business.
Setting up your business, which is extremely.
I forget the exact name. Hold on. Setting up a new business.
There you go.
Yes.
Setting up a new business with MJ Tax and Business Service. That's October 8th. If you like this one, you'll love that one as well. So one last chance for questions. Anybody has questions? Anybody want to be brave right now? Do we have anything else in the chat? Sliding up. Excellent. Thank you, Margot, for sliding that in. All right. So I want to, at this time, thank our presenters. Wait, hold on. I'm sorry. I'm at the part. Yep. I want to thank our presenters. It was a great session. I'd like to thank Jessica Prince and Arianna Swink of MJ Tax and Business Services once again for all their hard work. Also, I'd like to thank our funder, the City of New Bedford, for making this possible. Please visit our website, newbedfordcreative.org, and join our free creative directory. This is the list that we use to promote our own social media throughout the year. Make sure to add your events, galleries, exhibitions, or more to our calendar page that is linked to South Coast today. We want our creatives to excel, and we are here to help. We have plenty of peer-to-peer sessions coming up. Like we said, next week, we have MJ Tax and Business Services joining us again. The link is in the chat. That's October 8th. But we also have another session happening tomorrow, Wednesday from 6 to 8 at Interwoven with Rhonda Fazio. So if you're interested, we can slide that one into the chat as well. Please register for those sessions, and we will then send out the Zoom link. That's usually the way we do it. You guys have been fantastic. We appreciate you for joining us here. Once again, thank you to MJ Tax and Business Service for all of their expertise. And we will catch you guys either tomorrow or next week.